The Michigan Consumer Sentiment Survey came out last week, and what it said is consumers are very, very bearish and pessimistic on the overall economy. That survey, since it started in 1940, has never been worse than where we are at right now. The inflation rate is at a 40-year high, 8.6% year over year, with things like food and energy up dramatically higher than that. It is clear people's pocketbooks are being crunched. People are fearful. You can see this reflected in the stock market. You can see this being reflected in the real estate market now as well, with new mortgage demand at a 22-year low. It's clear we are heading into a recession, or like Bank of America says, potentially already in a technical recession, but we just don't realize it. So I want to talk about all of this information. Potentially, where does the stock market go from now? Is this an opportunity to grow your wealth in a very dramatic way? Or is this potentially a lost decade? Something that you will look back on and say, hey, I'm glad I didn't invest any money during that time. Now, hopefully this is a period of time where we look back at and we're hopefully much richer in a much better scenario, and we can all toast to the good times that we've seen in 2022. Now, without any further ado, let's get into all of this information. I don't want to keep you guys waiting. Your time is valuable after all. So some of the biggest things that I want to point out are inflation, or I should say is inflation, because what is really up over the past year are things that affect the American household the most. Like, sure, new cars, used cars, while it's not good that they are up 16% year over year for used cars, new cars up 12%, not necessarily a great thing, but how often do you go out and buy a new vehicle, right? It's not those things that are going to push us into a recession. It is the price of fuel that is up 106.7% year over year, or the price of gas, which is up 48.7% year over year. Utilities up 30.2% year over year. Food at home up 11.9% year over year. Electricity up 12% year over year. Those are the things that push economies into recession. Specifically, when the price of oil is over $100 per barrel, we have always seen a recession. Well, where has the price of oil been in 2022? It has been over $100 per barrel for the whole year of 2022, with the national average for gas just topping over $5 per gallon for the first time in history. This is what is taking all of that excess money that people have, that economists were so adamant about for 2022, all of this spending that was going to go on. Yeah, we're still spending, but we're spending all of that money on essentials that we need, like food, energy, travel, so on and so forth. So you're not going to be seeing that crazy spending for 2022. And specifically, why the stock market has been reacting so negatively is because there is a wide disconnect between what is expected and what the data is actually telling us. So most economists, as of right now, people that actually project earnings for the overall markets in a year, have EPS growth for 10.1% for 2022. We all know that's not going to happen. It's not going to happen. People are not spending like that. Simply not going to happen. So when you have this big disconnect between earnings coming in for some companies negative, but the overall consensus for 10.1% EPS growth for 2022, it's very hard to value companies and to fairly value companies. You add high inflation in there, which obviously, if a company says, hey, we're going to make $5 billion of profits by 2025, great. But if inflation's 5 to 10% per year till 2025, that $5 billion is going to be worth substantially less than that. That's why overall high CPI, high inflation is bad for business. On top of that, the Fed is going to be raising interest rates in a very dramatic way, and they are essentially already killing demand with something like mortgage rates. Going through the most historic rally we have seen since the Civil War, that market is being decimated with new home mortgages down to a 22-year low. It's obvious what is happening here. It's very obvious. But let's break down the math, right? So we go into a recession. We know we're going into recession in 2022. It's unavoidable. It's not a question at this point. If gas stays over $5 a gallon, like at all, let's call it 6 to 12 months, you could go into a worse recession than 2008. The question is, how much money do people really have to spend in the economy? In other words, how much stimulus is actually still out there? And we can see the personal saving rates are down to pre-COVID levels. And that's just a simple Google search, right? Personal savings rate. I have it pulled up right here. Down to extremely low levels. It's plummeted. So people are not saving money. This is where we were at, roughly getting to those levels that we were at right before the financial crisis during 2008. Specifically, we're at a 4.4% personal savings rate. After pre-COVID levels, we were at about 7.3%. So we're substantially under that. People are saving a lot less money. Obviously, not a great thing. They're spending it. They're spending it somewhere, probably on inflationary cost. As far as JP Morgan, they estimate that inflation is costing the American family $460 a month more than what we've seen last year. So that's obviously not a good thing as well. That's obviously not good. $460, that could be a mortgage payment for some people. So we're going into this recession. We are. Okay. So what is the earnings consensus for 2022? Well, specifically what we see right here is $225 for the S&P 500 earnings per share. Q1 expected $54.90 per share EPS. $56 per EPS for Q2, Q3 at $57 EPS, and $57 for Q4 EPS. Now, how the stock market actually gets valued is like this. You take the EPS, let's say the consensus, $225 EPS for 2022. Well, the markets on average trade at about 16.9 PE over the past 10 years. It can vary, right? It says the PE right now is about 17.6%, but let's just call it the average of 16.9%. What you want to do is you want to times 225 by 16.9, and that's a fair value for the S&P 500, around $380. We're currently trading at about $389. So on paper, it looks like we're at a fair value, right? But in this market, the markets are really controlled by 5 to 10 key stocks. Your trillion-dollar companies, those control the markets. For an example, Apple is 13% weighting of the NASDAQ. Microsoft, another 10% weighting of the NASDAQ. Just for the S&P alone, Apple controls about 7% of that weighting. So yes, we could be at a fair value for the overall markets right now, considering if we can have a 10% EPS growth rate for 2022. I doubt we can. So let's say the EPS is actually less than 225. Let's just call it 215. I think that's more reasonable. 215 EPS growth, that would still be up from 2021. We had 208.53 for EPS growth in 2021. But let's times that 215 by 16.9. That would be $300 $63 on the S&P 500. That potentially could be your low. That would be down here. And then again, it all just comes down to what the largest companies in the world report. If you start to see Apple, Microsoft, Google, Tesla, these companies like that don't report good numbers, you could go substantially lower than that. If you take a look at something like a Square or PayPal, this is a perfect example of how the markets can actually overshoot in a dramatic way. Look at this chart. We are substantially under the lows of the COVID crash that we actually seen. So if the markets lean more towards this negative sentiment in the markets could overshoot to the downside in a substantial way. And then the real question is, how long does the war in Ukraine last? Because that is directly related to food and energy for the most part. That is the biggest thing that is affecting the odds of a recession and how hard and how deep a recession will likely be. How long does that war last? I'm not a fortune teller, I don't know, but it looks like it could last quite a while. So what does that mean? Well, this recession, every single month that this war lasts, gas prices, food prices are up. That's probably adding a couple months to a recession. We already had our first negative GDP print for Q1. We will get the next GDP print coming July 28th. If that is also negative, we are in a technical recession. And if you take a look at this article, one of the main articles right now on CNBC, it says strong inflation, anxious consumers add up to more worries that recession has already arrived. The key points: reports Friday showing blistering inflation and historic lows in consumer sentiment painted an increasingly dark economic picture. A strong labor market has been the principal firewall against a downturn, but even that has shown some chinks lately. It says we're in technical recession, but just don't realize it, said Bank of America chief investment strategist Michael Harnett. And that's probably why you've been seeing Tesla firing or laying off 10% of their staff. Same thing with Amazon. Same thing for a lot of these very large companies. They're telling you something, right? But when you boil this down, what happens with the American economy? And what's a simple question you want to ask yourself? Ask yourself this, and this is what I tell people that are fearful about the markets. Do you think in the next 20 years the economy will be bigger or smaller? And I know a lot of people have lived through the past 20 years. They've watched the evolution of technology, cell phones, video game consoles, TVs, everything, right? PCs, what you're watching this video on probably did not exist 20 years ago. Are you willing to bet that the American economy will not advance in the next 20 years? I'm personally not willing to do that. Could this be a lost decade? I don't think so. But could we go through a couple years before we hit all-time highs in the markets? Most certainly. And why do I say that? Well, it really comes down to the federal funds rate and where growth is in the economy, because the federal funds rate needs to go up, right? That's a fact. We've never went into a recession with a federal funds rate this low. Federal funds rate right now is at about 0.77%. Obviously, it's a range in between 0.75% and 1%. Just call it 1%. Federal funds rate, higher end range at 1%. Well, the Fed's going to raise 50 basis points at the next at least two meetings, likely at the meeting after that one. So roughly be at about 2.5%. The projected federal funds rate by December is roughly 3 to 3.25%. But where does that put us historically? Well, if I can pull up the actual tab here, we could go ahead and look at it. Well, that still puts us very, very low. Even heading into COVID, we were at about 2.5%. Heading into the great financial crisis, we were at 5.25%. Why is this so important? And we've never been this low heading into a recession this quickly. Never in the history of the federal funds rate has this happened. Why is this such a bad thing? Because the Fed needs a federal funds rate up when you go into a recession so they can accommodate the markets when you're in a recession. The last thing you want is high inflation, the Fed raising rates as we are in a recession just to battle that inflation and unable to accommodate the market. So that accommodation you typically see during a recession, low interest rates, right? Hopefully, the stock market usually hits a bottom when you go into a recession and the Fed cuts rates, and then you can slowly trend out of it. We're not going to get that. We're not going to get that, especially if we get a technical recession coming in July. All bets are off the table. We've never seen something like this before. You've never had high inflation. You've never had the Fed raising rates during a recession, which they're going to have to continue to raise rates even if we go into recession. And you've never seen the consumer this overall negative since 1940. But when you boil it down, the economy will continue to do well over time. The question is, and the question you should ask yourself, like I said, do you think the economy will be smaller or bigger in the next 20 years? Do you think essentially the human race will advance in the next 20 years? And how long of a time frame do you have? If you have a year, 2, 3, 4 years that you need to make X amount of money, you're probably better off in real estate, municipal bond, treasury bond, something along those lines. Stock market might not be for you. But if you are able to buy quality companies that we talk about here on this channel, that I say that I personally invest in, something like a PayPal, a Square, a SoFi, stocks that are already beaten into the ground, you should come out of this in a very good situation and make a lot of money at the same time. Those are only my thoughts. That's the current situation. Potentially how low we can go on the S&P. 360 looks like it's inevitable. If you break under that, then you're going back to the peak before the COVID recession and the COVID crash, which is about 330 on the S&P 500. So yes, overall, you're probably closer to a bottom here than not. There still can be more downside, but it's not going to be a V-shaped recovery in the same way. Until the Fed comes out, accommodates the markets, drops interest rates. But that's not going to happen for years. So just be prepared with all of this information. Be out there buying the dip. That's the single best thing you guys can do for your overall financial situation if you have a multi-year time horizon. So that is all for this video. That's what you guys need to know. That's really what has been on my mind a lot as of recently. It can be a scary time, especially if you're newer in the markets, but this isn't potentially the last great buying opportunity that you will see in a very long time. Typically, when you go through a rough patch like 2008, you come out after that, you're going to go through a major rally. The overall system is going to be in a much better spot, and I firmly believe that to be the case this time around as well. So thank you guys for watching. Get your free stocks with Webull, Moomoo, and Public down below in the description. If you want to come join the trading group with me live in real time every time I make a trade, we have been killing it over there. Check that out. Link down below in the pinned comment. You guys enjoy your weekends, and I will see you in the next.